Hi there. Welcome to another edition of TokStocks. I'm your host, Kir Reynolds, and today we're lucky enough to have Bruce Campbell, President and Portfolio Manager for StoneCastle Investment Management, based right up here in Kelowna. Hey, how are you today there, Bruce?
Yeah, doing really well. Thanks for having me on.
Thank you. Really appreciate you giving up a little bit of your time here on a Friday. We're going to do sort of a good sort of top to bottom on exactly who you are, what StoneCastle is all about, and maybe some of the stocks and positions and sectors that you're liking.
Yeah,
Does
for
that
sure.
sound good?
Yeah, that's great. Yeah.
Excellent. So, why don't we go all the way back to a little bit about who you are? Where were you born and raised?
Yeah, so born and raised in northern Alberta, Grande Prairie, which is complete and total blue collar town, right? It's right in the heart of the oil patch, and not a lot of people talking stocks up there when I grew up. But for some reason, I took a liking to the market fairly early on, even so much that going back, this is going to date myself a little bit here, but when I was in high school, I was trading stocks on the telephone. You would dial the discount broker and have to punch a bunch of numbers to be able to execute your trades. And I used to do that on the payphone at the high school.
Well, it doesn't date you too much because the discount brokerage is a little bit of a newer thing. Would have been that probably would have been about the same time that I sort of bit the investment bug. But that anyway, that's interesting. Now it's like it's an app on somebody's phone, and they can be getting into trouble pretty quick. So from high school, calling up your discount brokerage and placing trades by the telephone, what was the sort of evolution from there, in terms of getting your first role? So you went to university and then how did you land your first role in the business and what was that?
Yeah, I got a finance degree and knew that I wanted to be somewhere in markets, but didn't necessarily understand what that was or where that was, and then just started to pound the pavement coming out of university to try to get that first job, and I did. I ended up at Richardson Greenshields, which was Richardson's family firm on the retail side, and that was the place I started. And it was, at that point in time, it was really dialing for dollars, right? Like you had no clients and you had to go get them. And at the same time, you had to learn the investment business. And there I was right out of university doing both.
So you're a bit of an asset gatherer, gathering some assets and letting the bank sort of, I guess you get a little bit of a choice of kind of where these things sort of go into. How does that sort of compare to what you're kind of doing today? Is it quite different, the investment sort of management landscape as it was with your first job?
Yeah, I mean, there's a certain amount of crossover. And I mean, I guess it was because of that, kind of first job that I kind of discovered some of the holes that I wanted to fill, and then started to really work on what my investment process was and how I figured out returns could be generated, and then went from there to kind of the evolution and to building StoneCastle. And I mean, it's not a lot different than what we do today. Part of our job is managing money, and then there's a part of client service and bringing in new money as well, like always meeting with new people. So it's a role, especially in a boutique like StoneCastle, where you have to wear multiple hats. And it was the same back then. It was probably back then it was probably more asset gathering and less investment management. Now it's the other way around.
Well, that's good. And so you started at Richardson Green Shields, a pretty well known shop for those of us that are a certain vintage. Then you were at TD Waterhouse and worked your way up to Raymond James. So was there kind of a progression? You went from kind of being an asset gatherer, sort of early sort of financial advisor, up to like learning the portfolio management side of the business and really being kind of a PM.
Yeah, that's the exact evolution of how it transitioned. And back when I was at Raymond James, there wasn't a lot of discretionary portfolio managers across the country. In fact, there was probably a handful at the Canadian banks. When I say that, on kind of on the retail side, and Raymond James was really kind of evolutionary at the time because they had developed a portfolio management program And I was at the time I was number 7 in that program across the country, and it was a kind of a 2-year apprentice program where you worked with another portfolio manager who oversaw really everything that you did, and that was really the launch towards the direction that StoneCastle was. And I'd already identified at that point in time that that's where I wanted to go. That was really what I enjoyed doing, was that, solving the mystery of the markets and trying to figure out how to generate return. And it was just a function of trying to get all those pieces in place. And that was, that started at Raymond James. And at the same time, I had already done quite a bit of work on trying to figure out, how I could build a sustainable and repeatable process to manage money. And those kind of two married together at Raymond James.
Excellent. And then that takes us to about 2008, the financial crash. And that's when around the time that you started StoneCastle. So, pretty interesting time. I guess if you're looking for market lows, that would be a good time to kind of go out on your own. It's really kind of only up from there. But take us through the thinking. What sort of gap in the market and did you sort of find, and why did you want to sort of start your own shop?
Yeah, I mean, it took a few years to get to that place, and part of, what I was doing the entire time at Raymond James was managing client portfolios on a discretionary basis. And at that point in time, there wasn't a lot of discretionary management. You really had to go to an investment counselor or have a mutual fund that would manage your assets on a discretionary basis. Most individual investment advisors were still just making recommendations at which the client had the ability to say yes or no to. And to have discretionary authority was a fairly big step. But I knew that I wanted to really be my own firm, and to go out. My family background is, I'm fourth generation small business owner, so that bug's been kind of planted in me since I was, can always remember, right? Being in business for yourself. And then I also got this stock market bug and investing bug, and so you put those two together, and it made sense that I would, start a boutique investment management firm. And around, kind of all around that was, there's a fair number of steps to go into starting your own firm. It's not just like, oh, hey, I'm going to do this one day and away you go. So there's a number of regulatory steps that you have to go through. And so started to put all the pieces in place and just, methodically walk through all of that process until I was ready to launch, which just happened to coincide with, September 2008, not knowing what the next couple of months were going to be all about. So it was definitely an interesting time.
Yeah, I'm sure if you're married at the time, your wife was probably thinking, "What are you doing?"
Yeah. Yeah, especially because we just had a baby as well. Our first son was born in
Yeah,
the end of August '08.
there you go. They usually are looking for safety, security, secure sort of income right around that time. Not necessarily going out on your own during a crisis where, I don't know if you can remember some of the craziness that went on. They thought that ATMs were going to stop
Oh
putting
yeah.
out money, and banks were going to go under, and it was a domino. And anyway, it's pretty wild sort of
Yeah.
period of time. So that's pretty interesting. And so, how did you decide? Hey, I want to start my own fund and my own investment sort of management firm, and I'm going to start it in Kelowna. How did you pick that?
Yeah, I mean, I was in Kelowna at the time, and really wanted to be here for lifestyle. And at that point in time, the world was, starting to broaden out to a certain degree. I mean, if I heard it once, I heard it, 100 times. Like, oh, you can't do this from Kelowna, and which just kind of motivated me a little bit more to say, no, actually, I will do it from Kelowna, and I have. And so, it was just a function of, yeah, putting those pieces in place. And I sort of figured out through part of that process was that, I love the interaction with investors, be it, either retail or institutional investors. But what I really love is that, piece of trying to figure out markets. And one of the things that I discovered or figured out along that way was that in order to do that most efficiently, that was going to be in a fund platform so that, the clients all kind of looked identical and that we managed a piece of their portfolio, but not necessarily their entire portfolio. And that was really why the StoneCastle fund was launched.
Yeah, and let's talk a bit about StoneCastle. So, what's the sort of investment universe? How many equities are you guys sort of like focused on, and how many funds do you have? Maybe you could just give a little bit of an overview on sort of StoneCastle and kind of your view on the world and what you focus on.
Yeah, I mean, if you look at what we have now, we're down to one fund, and we've really been focused and narrowed down on that. We used to manage two others for another company, and last year we decided to really control our own destiny. And those funds were shut down, and we returned all the capital back to investors so that we could just focus, control our own destiny, and focus on StoneCastle. And if you look at what we do, we really have kind of a tiered approach to investment management. So the first is, and this is one of the things that when I talk to investors all the time, I love to ask this question, and they can answer, but they can't always give you why they answered the way they do. But I also always like to ask, are you on offense or defense with your portfolio? And most investors, even institutional investors, can't really tell you why they're on offense or defense with their portfolio. It usually has a lot to do with headlines and what the kind of flavor of the day is on CNBC or BNN. And so we went about trying to figure out how it was that we could figure that out and build a system where we knew whether were we on offense or defense and what that meant to our actual portfolio. And then the second part of what we do at StoneCastle is that we're looking to try to find stocks that are going to appreciate at a faster rate than the overall market. We're trying to generate higher returns than the market itself. And so that was where, when you go back to Raymond James, that was where I spent a lot of time at Raymond James to perfect that and to really figure out what it was that went into stocks outperforming. And that's where we basically identified that the earnings and earnings acceleration had a significant impact on stock returns. So if you have a company that has accelerated earnings, so they're going from, say, where they were negative earnings to now they're positive earnings, and then the positive earnings are even accelerating at a rate where they're making 5% or 10% or 20%, then you tend to get returns in two ways from that stock. One is as the earnings are going up, but the second is that investors tend to discover those stocks at different times and fall in love with them. And so typically the multiples also increase if you find them early enough. So you're getting multiple expansion plus you're getting that earnings acceleration. And it can mean that you have the stocks that have significant moves in multiple quarters of earnings growth. And that's really how we've built our entire system at StoneCastle. When we look at our universe, we've really set the universe at North America. So we've got about 3,800 companies that we look at on a daily basis, and we're ranking those companies every single day, 1 to 3,800, so that we know where they are based on a number of different factors that we've identified drive that stock price.
And are there certain sectors or market caps that you kind of that comprises that 3,800 company universe?
Yeah, I mean, if you look at that universe, it's really kind of 100 million plus in North America. Sector wise, it's we're go anywhere, so we can look at any sectors. We don't necessarily own a sector, and we also cap our upside exposure on any specific sector. So we don't end up owning just one sector or two sectors, if even if that's where all the earnings growth is, because it just enhances the volatility of the portfolio, and we're trying to reduce that to a certain degree. But if you look at kind of where we normally kind of end up ebb and flow wise, is we really fall into that mid small cap territory for most of the portfolio. So if you looked at our portfolio right now, we've got roughly two-thirds in that small and mid cap area, and then we've got a third in large cap. And that's pretty typical of what we would see over a full market cycle. There's going to be times where the big is is a larger part of the portfolio, and that's driven by earnings. So if you look, kind of roll back the clock to 24 months ago now, we were seeing that earnings acceleration from those largest companies. So, everyone talked about the Mag 7 for a reason, because their numbers were increasing and they were doing so at an accelerated pace. Whereas something like, everyone's talking about the Russell 2000 this year, something like the Russell 2000 was actually seeing contraction in their earnings at the same time. So there wasn't the interest in those stocks, and they didn't rank as well. But over kind of a normal market cycle, you tend to see, the largest and the ones that have the most acceleration come from that small and mid cap group. And a lot of that has to do with the law of large numbers. It just becomes more challenging to constantly be accelerating your numbers as they get bigger and bigger.
Some of what you laid out in terms of the types of companies you're looking for that earnings acceleration. Hey, there's not too many of those companies that it would be listed here in Canada. That sort of a lot of those type of companies have been getting snapped up. Lots of M&A, lots of takeouts.
Yeah.
I guess they're not getting the same sort of multiple that you might find in private equity or south of the border on a larger exchange. Maybe for those, so you're kind of a growth investor, but you're looking for that sort of accelerated kind of growth. What do you say to people that are sort of, in Canada, it seems like smaller companies that would sort of be in the small cap or mid cap, a lot of those, a lot of our own exchanges are kind of tied up in sort of like the metals and mining sort of companies. Looking outside of that, what have been some of the companies that you guys have been in that have been quite successful?
Yeah, if you actually look at the Canadian market, there's a lot of other companies outside of that, the metals and mining and energy space, that have done phenomenally well, and in a lot of cases are pretty innovative in what they do. There's also a lot of companies that come to Canada to list, and they're maybe not necessarily Canadian operational companies, or they have a small part, but they're listed on a Canadian exchange. And so where we tend to find a lot of what our big compounders tend to be is in a lot of cases in industrial areas, in technology areas. We have in the past also seen, lots of healthcare, Canadian healthcare ideas that have done really well coming out of the Canadian market. And to your point, what ends up happening is a lot of these get, taken away from us. So they might start off as a $200 million company when we see them, and they grow to a $2 or $3 billion company, but then they get taken out. And sometimes that's disappointing because of the earnings that track that they're on. And then, we're forced to kind of look at something else and, kind of go back to our screens to figure out, where else is there, or what else is there in the Canadian market.
Yeah, it's kind of been in the last, I'd say, 2 or 3 years. There's been sort of dozens of companies, and seemingly a lot of the same types of investors have owned these companies. They've just been getting picked off one at a time. So I guess depending on how these things get acquired, it's usually at a pretty good premium. So there's probably some outsized returns, but it's one of those increasingly smaller pool of looking at those companies that are transitioning from negative earnings to positive earnings and then can continue to accelerate. That's kind of the trick. I know you guys look at other things besides just the Canadian market, but you're here in Canada, so I'm sure your phone is ringing off the hook here with people always trying to show you different things. What do you think are some of the key sort of fundamental sort of criteria that you guys kind of look for? Just is there anything outside of earnings? Are there a certain part of your model that you're able to share? Any of the secret sauce?
Yeah, I mean, I can talk a little bit about that, but just going back to your point about, the companies and getting taken over, I just wanted to add, like, we've, in the entire history of StoneCastle, we tend to have, it seems like, one or two companies a year that get taken out, that are currently in our portfolio. And there's been years where, I think we had a period of time, I think it was in 2016 or 2017, I can't remember specifically, where we had I think we had 6 months in a row where a company was taken out in our portfolio. So it seemed like every single month we were getting something that was being taken out. So so that's obviously an interesting trend, and it's something that is, I think, a function of that one piece that I talked about, which is that quite often the multiple isn't as high when these companies first start that path of earnings acceleration. And in a lot of cases, US companies that are public are trading at a higher multiple, and they discover that, and they realize, hey, this Canadian company is growing at this phenomenal rate, and it's half the multiple that we have. If we buy it, it's immediately accretive to our earnings because we're paying for those earnings and we have a higher multiple. So those earnings should then get attributed to our multiple, which will help bump our stock price. And so you see that happen an awful lot. So, and then just looking at, kind of what we dig into, yeah, a lot of it is earnings and valuation based is what we're looking for. So we're looking for the earnings and, kind of what the direction of those earnings is, but also the acceleration of those earnings. And it's, we look at multiple different levels of that. So, the revenue and earnings levels, but then, we're also looking at, what the expectation is for that company versus what the numbers actually are. And then we also like to see that they're meeting or beating those expectations, which also becomes more challenging over time because as the market follows you more and you get more analyst coverage, you always tend to get a little bit of excitement around the numbers, and as a result, there's always someone on the top end, and so it becomes harder and harder to try to beat those numbers over time. And so that's something that we look at as well. And then we also add a technical piece as well. So we're not looking to buy something that is falling or is super um, been flat from a price performance perspective. We want to see that the market recognizes what we see, and we talk all the time about. I don't know if you remember that show, Who Wants to Be a Millionaire. Do you remember that?
Yeah, yeah.
Yeah. So if you go back to that, I remember they had the lifelines, and one of the lifelines was ask the audience. And if you kind of looked at the statistics of what happened, the ask the audience was right in the high 90% of the time. It was very rarely fooled. And we think the same thing with the market is that, there's times when the market gets fooled both from a macro perspective, but also from a company perspective. But typically it's right, in the high 90% of the time. And so we want to make sure that what we recognize, the market also recognizes, because there's a whole lot of people out there doing a whole lot of work that know probably more than we do on any one of those individual companies. And we want to make sure that that's in the stock.
And do you ever sort of like meet management as part of your like process? Is that something important, or are you all just like, hey, let's read the financials, let's look at the fundamentals, get in touch with the company and speak directly with management and meet with them? How does that sort of fall into the process? That can be a bit of a controversial point. Some people don't want to have any access, and some maybe think it's too important. Where is that on the scale for you?
Yeah, I mean, we certainly do meet with a lot of management teams, a lot more probably on the small and mid cap size. The large cap, first off, you just don't get access to them to the same degree. I mean, if you do, it's probably at a big institutional conference, in which case you're probably not going to get a whole lot more than by listening to the conference call on their quarters. But with the smaller management teams, yeah, we do, or the smaller companies, we do like to meet with them. And it really has kind of twofold reason for that. I talked about the fact that we're looking for that kind of $100 million minimum size. And so there's a lot of companies that fall underneath that. And we like to meet those companies because then we have a good sense of what they do and how they do it and what the catalysts are for their business. And that also applies to the small and mid cap areas by, drilling in and digging into a company to understand, okay, well, this is where the earnings are coming from now. Is that trend sustainable? One, but two is, do they have something else in their business that's just about to, be another growth avenue for their earnings that you might not discover when you when you just read financial statements or read the conference call transcripts. But when you sit down and talk to them, they'll say, "Oh, like this is what we're seeing, and it's a small part of our business now, but like this is the runway for where it could be big in a couple of years." And it just allows us to be able to track that. So when we start to see something show up on a screen, we know, oh yeah, hey, that's probably what's happening. You dig in and you find out, yeah, that's exactly what we've seen is something we talked to them about, a year ago or 24 months ago.
How many companies are you typically like meeting with sort of in a year? How frequently?
Yeah, we probably do calls with I would say or meet with probably around 100 a year.
That's pretty good.
Yeah.
And any stories about some of the people? You don't have to go into make any name anybody, but I am a big fan of having interaction with company management, and sometimes maybe you learn just how great they are, or maybe how it maybe isn't a good fit. Any surprises along the way for you?
I mean, there's always lots of twists and turns for sure. It probably has to do, I would say, there's a wide range there, right? You have, management teams that are just so incredibly solid and they're fantastic operators. And then you have the opposite where they're, not very good on the operational side, but they're, fantastic storytellers or stock promoters. And then you kind of have everything in between.
Sort of an insanity wave. We're due for one. Feels like we're really. I don't know. Are we in it on the metals and energy front? Are we getting it? It seems like there's some pretty rambunctious people that just ran a big conference in Toronto there for sort of the mining and metals. But outside of that, man, we need another good one for Canada. But anyways, I digress. How do you guys take a position in a company? Are you guys just buying shares out of the open market? Do you participate in like private placements or pipe offerings or things like that?
Yeah, I mean, we do a combination. I would say the majority of what we do is in the open market, but there's always companies that are on our radar that we're watching. And if they're doing a financing in some capacity and it meets our criteria and we want to add to it, either to increase the size of our position or just to take an initial position, yeah, we're participating in financings as well.
Excellent. And are you doing long only, or you do long and short sort of positions?
Yeah, we have the ability to be short in with our portfolios. We don't do a lot of individual stock short. We will in some cases, and those tend to be larger cap just because they kind of miss most of the time. They miss the catalysts of some big news really impacting their stock price. So historically, when we've been short, it's usually kind of sector based, ETF based, or a basket of larger cap companies from one sector.
And what about sort of like risk management? How do you guys sort of like manage that?
Yeah, I mean, there's kind of multiple ways that we do that. One of them is our top down. So as we talked about, we're offense or defense with our portfolio, and so we'll adjust quite actively what our portfolio looks like. And when I say that, we'll be 40-50% cash at times. We'll have some short positions in there as well if we're on defense. And then when we're on offense, we don't typically have any short positions, and we're fully invested, and we'll take advantage of that. And then on the individual stock side as well, we manage all of our position sizes. So in our portfolio, if we were to start off today, we would hold 40 companies and they would all have an equal weight. So they're all going to have a 2.5% weight in their positions. And then as, kind of market forces take over, business forces take over, those position size will then be actively managed. So if it got too big, we would cut the position size back. So usually over 5%, we're cutting that back. So if it's doubled relative to the rest of the portfolio, it'll have a 5% weighting. And we're looking to cut that back just because we want to remove some of the volatility of a negative impact, plus harvest some of our capital gains that we've had. And then if it starts to drop in our ranking, what we'll do quite often is we'll cut it back by half. So if it started at that 2.5% position, we'll cut it back to a 1.25. And we do that because that earnings projection has started to flatten out a little bit. And that can be, kind of one or two different directions. It can accelerate or it can decelerate. We cut that position back because we're not too sure where it's going to go. And if it starts to decelerate, we want to sell it. Whereas if it starts to accelerate, we'll add it back. And we'll do that with the ranks, and we'll also do that with some technical tools that we have as well. And so we manage our position sizes based on that as well.
Maybe we could talk your book a little bit. Any particular stocks that you might want to highlight? Any particular wins that you want to talk about in
I
terms of
mean,
in terms of how you identified them, and then what sort of return you've been able to experience?
yeah, I mean, I can go back and talk about lots in the past, but it probably doesn't have as much relevance as, kind of more timely and current stuff. And I mean, the one that, you kind of mentioned in the, in the green room there was Kraken Robotics, right? And I mean, it's been a absolute darling in the Canadian market in the last couple of years, but it's fascinating. Like there's another good example of, a company where we would have done a call with management gonna, oh my gosh, it seems like it was probably 5 years ago. You know, Interesting company, interesting concept, but they were just kind of wallowing away, not really accomplishing too much. I mean, that was our perception. That wouldn't have been theirs. They were, diligently working to grow their business. And it's the, overnight success, which if you talk to the management team, it wasn't the case, but that was kind of how it shows up for us that all of a sudden, bang, they have that blowout quarter, stock starts to move. We see it in our ranks where all of a sudden the earnings have come up and now it goes from, oh yeah, Kraken that, we have one of those guys up to, oh, Kraken, they've, got this new market that they're tapping into and the stock's really starting to perform and the earnings is really starting to perform at the same time. And we found that one relatively early. There was a lot of people who found it a lot earlier than we did, and it's done phenomenally well for investors over the last, call it, 24 months.
Excellent. Yeah, that's a good one. I own that as well. So it's about 10 bagger territory for me there. So good.
Yeah,
There's someone else in town here who likes it quite a bit, who's made sure everybody knows about it. So that's good.
yeah.
What other companies maybe that you liked, and anything more relevant now that you're able to talk about,
Like something that we're adding to, or
or that you've got in there and you're up a little bit and it's still a relevant current position that you're not kind of giving away and going to compete with?
Yeah, I mean, like even going back to Kraken, I mean, we they just made this acquisition and we participated in the financing. So, we still like that. I mean, there's a good example of a question you asked earlier, like, will we participate in financings? Well, we had a position and we added to our position on the financing based on the acquisition. So, that's a great example. I mean, right now something that's been fairly timely has done well for us, but we still think has lots of opportunity is Tenaz Energy. And I mean, if you kind of go back and look at that again, it probably went flat for a couple of years. Well, Tony Marino and his team were, kind of outsourcing, what they wanted to do, and they were scouring the earth to try to find a deal. And then, they put it in place, and we popped it into the model and could see that, the earnings were going to accelerate based on the acquisition that they had just completed. And, we took a position, and at that point in time, it was sub kind of $9, and here it is at 50. And, they've now done a couple of acquisitions clearly because of, the geopolitics that are happening right now. European gas is spiked up in price, which hasn't hurt the stock. I mean, it was one of the few that were up this week when we've had a down week. And I mean, they've told quite publicly that they're not done. They're going to go out and make more acquisitions. And if you look at how they did it with their first one in particular, where it was almost like no money down to buy it. They bought it with its own cash flow. Really, they'll be creative in that capacity, and that could really pay more returns going forward.
Yeah, excellent. I had to go back. I remember that being a name from some time ago, and boy, I guess that when they restructured it, it was like just over $4 or something, and the stock's like what, a 45-50 dollar stock today.
Yeah.
Pretty wild. So congrats on that success, getting that one. Oh, uh, you've been sort of doing this. You've been, being a portfolio manager and managing discretionary for quite a while. What's the biggest sort of like thing that you're always like, ah, darn, what's the common mistake that investors that are not professionals, sort of professionally managing money like yourself, what's a common thing that you always sort of like run into, or even with some of your high net worth sort of like clients that sort of bring you money and you sort of get to know them? What's sort of a common mistake that people tend to make?
Well, I mean, it all depends on kind of who you are for sure. But when we look at the world, we're always shocked at how little process people have in making investment decisions. We've tried to make it as scientific as possible, and there's still certainly amount of a bit of an art form to what we do, but we've got a lot of rules and checklists in place. But when we come in contact with a lot of investors, what we find is that a lot of them, for the most part, don't have that. I'm a guest on BNN, and I'm shocked at how often I talk to people about BNN, and they talk to me about how that's how their portfolio is built, that they watch BNN and they either take what the guest's opinion is of the stock, or they just hear something that's of interest and then they add it to their portfolio. And a lot of them potentially can do well at the start, but they also don't have that process on how they sell. And I think that's important as well. If we were to have a room of 100 people who are all investors, and we said, who's made money on a stock, and everyone's going to put up their hand, and we said, okay, who's had a stock that where they were making money and have lost money, and pretty much everyone's going to put up their hand, right? And I mean, it doesn't have to be that way if you have a process. But again, going back to the BNN example, there's lots of times when we talk about a company on BNN, and at that point in time, it's a top stock in our rankings and in our system, and things change. Like, business happens, and as a result, maybe a quarter or 2 quarters after we talk about it, it gets removed from our portfolio because something dramatic has happened to their business, or to the market, or relative to everything else. We sell it out, but then they'll phone us up a year later and say, well, hey, like, what do you think of this? And I'm just like, well, we sold it. And they're like, oh, you sold it? Oh, well, we thought you liked it. And I'm like, well, we did at the time, but then things changed. So people quite often don't have that process. And that's one of the things that we are always surprised with, that this is people's money that they've worked super hard for. And yet they sometimes don't treat it with, in our case, what we would consider the respect it should get.
Right. I think also we've made investing pretty informal, like being able to do it on your phone.
Yeah.
It doesn't seem all that much different than placing a sports bet now.
Uh-huh.
I find it pretty wild that the ramifications of just how easy it is, and how there's no rigorous sort of like, there's no process to be able to place a trade while you're sitting on the couch or something. So pretty wild how that sort of has changed. But thanks for that sort of aspect. What are your sort of assets under management like for StoneCastle?
Yeah, it's not something that we really disclose a lot. The Canadian market tends to be pretty active, and there's lots of people who will try to come after you if they know that you have a position in a certain stock, just to squeeze you. So it's not something that we like to talk about and disclose.
All right. And you've mentioned a little bit about sort of like having a dashboard and having a universe. Are any of these tools that you're using sort of like proprietary? or is it your process that's sort of unique to yourself? Maybe tell us a little bit about your team. How big's your team?
Yeah, so there's three of us on our team, and if you looked at what we do, none of what we do is necessarily proprietary from the perspective of you would be able to replace it if you knew where to look and what how to put it together. So it's there's nothing necessarily proprietary about it. I guess it would be like KFC recipe, right? Like I'm assuming that all of the ingredients that go into KFC, you could go out and probably buy at the grocery store, but you don't know how to mix them together to get what tastes like KFC. And it would be the same with us, right? So everything that we have in there, they're all ingredients from the investment world in different places. It's just how we piece them all together to come up with our formula.
Right. Are there any sectors in sort of, I guess, the Canadian small cap sector, sort of probably in that, sub 500 million market cap, any sort of like emerging sort of like sectors? We've heard a little bit about, there's all this concern about AI sort of eating SaaS. Are you like seeing any unique opportunities that you think are pretty interesting?
I mean, the beauty of the markets is there's business is always evolving, markets are always evolving. So there certainly is always opportunities. And if you look specifically at the SaaS and software and what impact AI is going to have, I really don't. I think it's probably overdone. Does that mean every single company it's overdone? No, there's going to be companies that are definitely hurt that can't respond and get put out of business. You think about Netflix and Blockbuster, right? Like there's a good example. So the Netflix of the world will evolve and use AI and continue to do well, whereas the Blockbuster might get replaced. And we're always on the lookout for that because there are going to be changes in the next 10 years that probably are hard to even fathom right now. And you think about, what happened from 2000 when the internet really kind of became mainstream to how it is today. Like, and we were still training on computers, and now we're using an app on our phone, just as one example, right? And AI, if you think about you know, most everyday people weren't using AI in any capacity 2 years ago. And now, it's certainly more mainstream and it just accelerates. And it is accelerating at such a pace that it's in some ways hard to really comprehend where it'll go. You just have to follow it as it's going.
Yeah, for sure. It's pretty wild, pretty interesting. Some of these larger companies, like they're sort of one upping each other with new functionality. So it'll be really interesting to see how it continues to sort of have an impact. If you look at a company like Constellation Software, CSU, for much of my sort of probably half of my microcap sort of investing kind of journey, that company was a bottom left, top right, perfect
Yeah.
chart. This is one that you have to own. Don't even think about it. And it hasn't really been performing all that great lately, and there's been a bit of a tantrum from those sort of diehard sort of owners of it.
But
So,
like, and there's a good example. You kind of
yeah,
wonder what is actually going to happen there because, if you
yeah,
think about what their model's been, it's to go out and make acquisitions of software that's kind of
right.
used on a everyday basis level in multiple different industries. And now all of a sudden, those software companies that they would potentially have been buying are probably worth a lot less. Yeah, their stock prices peeled back, but they still have this cash flow to go and make acquisitions. And now they probably don't have as much competition because everyone's whoa, like they're scared of what AI could be. So if their innovation officer is on top of things, they'll be able to roll that AI into all of those businesses, keep them going, and yet their acquisition machine, they'll be able to go in and probably pick up some pretty good bargains here that they haven't really had the access to the same degree in the last decade.
Absolutely, it'd be really interesting to see how it goes.
Yeah,
I am personally surprised at the step change of some of the AI. Like we heard a word last year called agent or agentic,
yeah.
and I think we're not too far off some of these platforms just changing changing it to like employee or staff member,
Right.
and it'll sort of be able to do that. It is pretty wild. I've sort of gone down a bit of a rabbit hole
Yeah.
related to my own sort of business on it, and it is pretty wild how it's progressing. A few years ago, I was like, "Oh, that's going to have no impact. That's really got to improve." Now I'm starting to be like, that's pretty interesting. That's pretty interesting stuff. If we can get the hallucination sort of down and more complete sort of work, I think it is going to have an acceleration of issues. But anyways, we could talk sort of all about that all day long. Let's just say that I gave you $1 million today, and I would limit you to 3 stock ideas right now, today, like this week. This week's been crazy. Got 3 names for me?
What's my time horizon? Is this for the next 10 years? And I can't touch them?
Sure. Let's say you're not going to touch them for 3 years. So 10, I don't know, 10's kind of far out. That's a real commitment. That sounds like someone
Okay.
who that sounds like somebody who manages money who doesn't want redemptions. But let's say your time horizon is 3 years, and you got 3 picks, and you got $1 million. No hedging, no wiffle waffle. What are 3 names that you think somebody should look at, or you would lock at?
And this is, I'm going to caveat this with not just like complete safety. We're trying to generate
Oh
returns as
yeah,
well,
this is
right?
like let's
Yeah,
get
because I mean, we could
outside.
just dump it into the Royal Bank and just collect our dividends and be done, right? But like we're going to be a
No,
little bit
let's
more
make it
adventurous
interesting.
and
Let's
like that.
make it
Yeah,
interesting. Interesting. We
yeah,
want some. We want some alpha. Come on.
yeah. So this MDA space is one that I would probably have a real hard look at because if you look at what's happening in that sector as we've gone from it really being like a government run space agencies to now you have these private space agencies or space companies, and the cost of getting into space, it just keeps dropping. And so when it drops, it's just building a bigger and bigger market. And they really are a leader in a number of different areas of that market. And so they had a challenging year in 2025, losing a fairly big contract just because of a acquisition, and then there was rumors of another contract, and it took the wind out of the stock. But long term, I mean, that's going to be one that just does phenomenally well.
Yeah. So it sort of got cut in half or thereabouts, down quite a bit. It was down into the low 20s, and then it's since rebounded. So you're sort of right back to kind of the price around that it was trading at in the summer. And then we've got some interesting things that are kind of happening. We've got a rumor of like something happening with SpaceX.
Yeah.
So maybe Elon's going to make space technology companies great again, make it interesting. So that would be that's one equity. I like that one. That's a good idea. What are 2 other
Yeah.
ideas?
Yeah, I mean, one that has had a pretty amazing run, and I think has to probably grow into its multiple and its valuation here, but has the potential to be much bigger based on a number of different things. And what's the saying, like if you discover what the incentive is, you'll figure out what where the motivation to take the stock is, right? And it would be Happy Belly Food Group, right? Like
Hey,
that's
yeah.
that's a situation where the management team has this massive opportunity to own a lot of the company if they are able to propel the stock to certain levels. And it's had a unbelievable move off of kind of where it all started, but I think they have the ability to continue to do that over time. And it probably is lumpy as they get the numbers and as people discover it. But again, we're talking 3 years here. So if you roll back the clock 3 years ago, it was probably doesn't even show up on the stock chart where it was.
It's probably 10 cents or 11 cents,
Yeah.
something like that. So today it's $1.75, $1.80, give or take.
Yeah.
So, and just to get in their business model, they're a rapidly expanding QSR, quick service restaurant company that has multiple brands. So, do you get a chance? Do they come out and see you? You get some meetings with them?
Yeah.
When are you going to open up a franchise? Let's get together and get one of these Rosie's Burgers.
Yeah, exactly. I've asked a few times when we're going to get one here, and he seems to be hedging his bets a little bit. It sounds like UBC's getting it before we get it. So, and then not UBCO.
Yeah,
So,
yeah,
so yeah, we might be waiting still a while.
yeah. Kelowna's a tough market. It really is for restaurants. Like we're still going to hang out in the same ones we probably have for the last 10 years. It's
Yeah.
definitely hard to sort of break into. They've got bigger cities to go and penetrate first. All right, so that's stock number two. That's a good idea. That's an interesting idea. Very diversified of you. What's your third idea?
Yeah, I mean, I'm trying to round it out here a little bit. My third would be exchange income. And if you look at your past example there that you gave, which was Constellation Software, it's been a amazing compounder, even with where it is now. And exchange has been exactly the same. Like if you look at the compounding effect that return that exchange income has had, it's done it, with a dividend and with share price appreciation growth. And the management team, it's not like they haven't had to manage some really challenging situations. They have been able to manage their way out of it. And I just think that, there's a trend there. There's a couple of trends there. One is that, you're seeing probably over the next decade, there's going to be this massive move from businesses that are founder led, that founder is now getting out of the business and they're retiring. And so somebody needs to take that business over because they're not just going to shut it down. And that's where exchange comes in, is they'll come in and buy, they'll buy that business and they'll inject capital and they'll, build it up and just keep increasing it. So there's going to be a massive amount of that with, kind of their competition in the past has been private equity. And I think there's going to be less private equity competition going forward just because of the fact that, private equities had a little bit more challenge here of late because of valuations and liquidity and, gating some of the funds. And I mean, that's not across the board, but it's certainly in pockets. And so the flow of funds might not be the same, whereas exchange has access to the markets both from a equity standpoint, but they've also just gone through the whole, um, you know, real institutional debt process as well, where they have access to a big debt line, which allows them to make the acquisitions on a bigger and bigger scale, and then pay them down with the cash flow.
All right, that's an interesting one that rounds you out. So those are the three. And what's the ticker on the last one on exchange income?
Yeah, it's EIF.
Alrighty, and we've got MDA, we've got Happy Belly HBFG on the CSD, and then we've got your exchange income. All right, excellent. Thanks for that. I know that was a little bit painful. Are there any investment conferences or things that you sort of like go to sort of get out of your kind of own bubble and your own process to maybe meet some things or get some corporate access? Anything that you sort of regularly attend or think is of good value?
I mean, there's a few depends really kind of on the two things that we typically will look at is what the program is as far as like what our access is. And then also probably from a thematic standpoint, what's in that conference. So we don't tend to go to very many specific conferences for an industry. We tend to more go to the generalist conferences because then we get a flavor of a few different things. One is what's being dominated there, and sometimes that can be a contrarian standpoint. And then the second is that a lot of times at those generalist conferences, you really find kind of the orphaned or just emerging company that is just trying to, kind of make their way and make their name, and they haven't fallen into the, big conference specific industry area yet. And that's where you can kind of really discover them. And at the same time, put them on your radar and watch their progress as they move along. So there's a few that we go to, nothing that I, have on the calendar and say I'm going to that every year or every quarter, it just really kind of ebbs and flows.
Any sort of like books, any book recommendations that you can point our viewers and listeners to?
I mean, there's so many good investing books out there. I mean, the basis of, if you kind of go back to the origin of how we manage and what we look at, and I talked about the ingredients and the formula, but if there's a book by a gentleman by the name of Jim O'Shaughnessy, which is What Works on Wall Street, and he basically broke down over a time period different factors that drive returns in the market, and we've adopted kind of that approach to how we built our strategy by looking at it from a factor basis and then marrying all those factors together to really drive that process. So that's one. There's a number of different fairly good um technical analysis books. And then the I'm trying to think of the name of it. I can't think of it for the life of me right now. But there's a book on trading which is excellent, and it's called The Art of Execution.
There we go.
And it's quite a fascinating book because it was a UK manager of managers, and what he did was he looked at all of the trades for his managers over a 10-year period, and then classified the managers into different categories based on their investment style when they were making money and when they were losing money. And if you read the book, it's an easy read. You'll then be able to identify what type of investor you are. And you also will be able to figure out what you can do to generate better returns going forward. And it's one that I probably pick up and read, every year just to kind of refresh on everything. But awesome book.
I'll have to add that one to my own repertoire. I haven't read that. That sounds interesting though. What about some of the like new age sort of publications? Any like Substacks or anything that are like interesting to you, or is it just too much noise these days?
I mean, it's more entertainment than it is anything else. I shouldn't say entertainment. I mean, it gives you a wider background on what's happening, but we don't use it as part of an investment process. So it's not like we're reading someone and they're talking about this or that. It's more to get a sense of trends, so that then when we build that into our, when we look at our system, we understand why certain things are happening inside of what we see. If all of a sudden a certain sector is rising up through the ranks, well, why is that? Well, maybe we've read in Substack or listened to it on a podcast, and we know, oh yeah, that makes sense why this sector's coming up or going down.
Excellent. And I'd be remiss if I didn't mention that you sit on the board of Decisive Dividend, which is kind of a born in Kelowna success story and it's in its own right. And maybe you could explain a bit about what its business model is, and how it's maybe a little bit different than your own sort of, like, it's obviously different than StoneCastle sort of investment process. But maybe you could talk a bit about Decisive.
Yeah, I'm certainly happy to. Yeah, one of the co-founders of Decisive, and I talked about exchange income, and I didn't talk about Decisive because of just conflict of interest reasoning. But if
Sure.
you like the exchange income thesis, you would like the Decisive dividend thesis as well. It's in very similar type of business. So, as a company, what we do is we go and look for manufacturing companies specifically that are transitioning from a founder led company that they're getting out of business, they're retiring for any number of reasons, and we buy that business. In a lot of cases, those businesses have been capital constrained for a number of years, and a lot of in most cases, the business owner knows, like, oh, I'm going to be selling this in a couple of years, so why do I want to spend X number of dollars on this new equipment? I can just limp along and do what I'm doing. We come in, buy the business, and then inject that capital, which means it then grows. We pay a dividend, and there's also share price appreciation from that. And again, it's going back to that trend over the next decade. All of these baby boomers are going to be selling their businesses, and if they don't have the ability to pass it on to the next generation or to existing management, then that's where we come in and pick it up from a Decisive standpoint.
Excellent. Thanks for covering that. That's one I also own, and that's it's had a pretty good year, sort of recovery kind of year, on in terms of its stock price. It's obviously under the hood is a different story, but anyway, super interesting business. Love those sort of like well oiled machines where you can roll up and acquire at a reasonable price. So pretty interesting stuff for sure. Now, tell me a little bit about you're living in Kelowna. What about your family? You got some family?
I do, yeah. I've got married and have a couple of teenage boys. Yeah,
And are they
so
into any sports?
yeah, they're both pretty big hockey players. Spend a lot of time in hockey rinks over the winter, and well, even the summer it seems like as well. So
Have you gotten dragged into doing any coaching?
over the years, I have. They're at a level kind of beyond where I'm at now from a coaching perspective. But yeah, when they were little guys, I certainly was always on the bench helping out.
Nice. Are they going to follow Dad in his footsteps and maybe get into managing some money and building out the StoneCastle brand, or they got the NHL in their future?
Well, once they're done in the NHL, then at that point in time, yeah, one of them certainly seems like he's a little bit interested. But yeah, I mean, he's also young, so lots can happen between now and then, right?
Yeah. Yeah, maybe you'll be doing some player management.
Yeah.
Yeah, and trying to manage their finances. Anyways, I really appreciate you getting on here. Been a very sort of enlightening chat. Thanks for sharing a bit about some of the stocks you like and what you would do if you had to do something today, and a little bit about StoneCastle. Maybe you could. Do you publish anywhere, or is there anywhere people can understand the performance of what your returns sort of look like?
Yeah, I mean, if you go to our website, there's information on there, and then if you sign up on our distribution list, you can also we send out various different things there as well.
Yeah, you do like a weekly newsletter, if I'm not mistaken, where you do a bit of a recap. So,
We
I
we do and we do a monthly webinar as well, which we kind of talk about our top down process. So we'll talk about are we on offense or defense at any point in time.
well, thank you so much. I really appreciate the time there, Bruce. Nice to connect, and have a wonderful weekend.
Yeah, you too as well. Thanks for having me on. It's great to have joined you.